I know how tired you are. Not the dramatic kind of fear that comes with sudden crashes, but the slow, grinding exhaustion that builds when nothing seems to happen for far too long. The boredom, the quiet discouragement, the constant internal question of whether all this waiting actually means something or whether you have simply been standing still while the rest of the world moves on. That kind of fatigue is heavier than panic. It settles into the body. It shows up as reduced enthusiasm, as checking prices less often, not because you are confident, but because you are worn down. If that's where you are, there is nothing weak or foolish about it. This is exactly how prolonged sideways markets are meant to feel. They are not designed to scare you out. They are designed to wear you out. Most investors believe they will fail because of fear. They imagine panic during crashes, sudden sell-offs, or moments of extreme volatility. In reality, that is rarely what ends long-term positioning. The real enemy is emotional exhaustion. It builds slowly during long periods of sideways movement, repeated delays, and the absence of clear progress. Unlike fear, exhaustion does not feel dramatic. It feels quiet, heavy, and mentally draining. It shows up as indifference, reduced attention, and a growing sense that holding no longer feels worth the effort. Emotional exhaustion weakens decision-making without announcing itself. When markets move violently, investors become alert and focused. When markets move slowly, the brain receives no clear signal to act, yet it remains under constant low-level stress. Over time, this creates cognitive fatigue. The investor starts questioning not just the asset but their own judgment. Doubt replaces analysis. The desire for relief replaces patience. Decisions are no longer made because the market has changed, but because the investor wants the discomfort to stop. This is why long consolidation phases remove more participants than crashes. Fear can be managed with risk awareness and preparation. Exhaustion bypasses logic. It convinces people that waiting itself is a mistake. Investors exit not because they believe the thesis is broken, but because they no longer have the emotional energy to stay engaged. That exit often feels rational, even responsible, because it restores mental calm. However, it is usually disconnected from any real shift in fundamentals or structure. From a market psychology perspective, this is not accidental. Sideways environments function as filters. They test patience, discipline, and emotional regulation rather than intelligence. Capital with long-time horizons understands this dynamic. It does not react to boredom or silence. It remains positioned because it recognizes that emotional fatigue among retail participants often appears just before meaningful transitions. Understanding this difference matters. Fear creates fast mistakes. Exhaustion creates quiet ones. Fear pushes people to act impulsively. Exhaustion convinces people to stop caring. Long-term investing is not about avoiding fear entirely. It is about recognizing exhaustion early and refusing to confuse emotional discomfort with strategic necessity. When investors learn to identify this state, they regain control, not by forcing conviction, but by separating how they feel from what the market is actually doing. Sideways markets are often misunderstood as proof that something has gone wrong. Many investors interpret long periods of slow, uneven price movement as failure, weakness, or lost opportunity. In reality, sideways markets are not breakdowns in the system. They are psychological tests built into how markets function. Their purpose is not to deliver quick feedback, but to measure patience, discipline, and emotional stability. When progress is not visible, the mind fills the gap with doubt, even when the underlying structure remains intact. A sideways market removes external validation. There are no strong trends to follow and no clear signals to confirm belief. This absence of direction creates discomfort because humans are wired to seek momentum and resolution. Over time, investors begin to confuse the lack of movement with the absence of value. This is a critical mistake. Markets do not move continuously. They pause, consolidate, and rebalance. These phases allow positioning to occur quietly while attention and enthusiasm decline. From an investor psychology standpoint, sideways movement creates pressure without drama. Unlike sharp declines, which demand immediate reaction, slow markets drain confidence gradually. Investors start questioning their timing, their research, and eventually their judgment. This erosion does not happen because new negative information appears, but because nothing positive seems to happen. The test is not analytical, it is emotional. The market is asking whether the investor can remain rational when rewarded with nothing but time. Long-term capital understands this dynamic. It does not interpret sideways behavior as failure. It views it as a necessary stage between accumulation and repricing. During these periods, weaker hands exit not because they are wrong, but because uncertainty becomes uncomfortable. This transfer of positioning is subtle and rarely noticed in real time. Recognizing sideways markets as psychological tests changes how they are experienced. Instead of reacting emotionally, investors can evaluate whether anything has truly changed in structure, adoption, or utility. Often, the answer is no. When nothing meaningful has broken, sideways movement is not a signal to panic. It is a signal to observe, remain patient, and avoid confusing emotional discomfort with actual risk. Selling during exhaustion is often misunderstood as a rational, well-timed decision. In reality, it is usually an act of relief rather than strategy. Emotional exhaustion builds slowly in long, quiet markets where progress feels delayed and outcomes feel uncertain. Over time, the investor's focus shifts away from analysis and toward emotional comfort. The decision to sell is no longer driven by changes in structure, utility, or long-term positioning, but by the desire to escape mental fatigue. Exhaustion alters perception. When an investor is tired, the mind begins to frame waiting as risk. Holding starts to feel irresponsible, even when no new negative information has appeared. This is not because the investment has changed, but because the emotional cost of staying engaged has become too high. Selling provides immediate psychological relief. It restores a sense of control and quiets internal doubt. That relief feels like clarity, which is why exhaustion-based selling is often defended as logical. From an investor psychology perspective, this is one of the most common ways long-term positions are lost. Markets do not need to force investors out through fear. They allow time to do the work. Prolonged uncertainty combined with constant EXP, osure to price movement slowly drains conviction. Eventually, the investor exits not at a moment of maximum risk, but at a moment of maximum fatigue. Strategic decisions are based on evidence, not emotional pressure. A strategy evaluates whether the underlying thesis, structure, or long-term relevance has changed. Relief-seeking evaluates only one thing: how uncomfortable the investor feels in the present moment. The market often exploits this difference. Exhaustion peaks near the end of long consolidation phases, when attention is lowest and patience is thinnest. Understanding this distinction restores control. When investors recognize exhaustion as a psychological state rather than a market signal, they can pause instead of react. This pause does not require blind conviction or forced optimism. It requires separating emotional discomfort from objective change. Selling during exhaustion may feel responsible, but without structural justification, it is rarely strategic. Long-term capital does not operate on emotion or visibility. It positions itself during silence, not during excitement. When markets are loud, crowded, and filled with confidence, most of the opportunity has already passed. Excitement attracts attention, but attention attracts competition. By the time enthusiasm is widespread, price usually reflects it. Long-term capital understands that real advantage is created earlier, when conviction feels uncomfortable and participation is low. Silence in markets often signals uncertainty, not weakness. It is the period when narratives lose energy, public interest fades, and price movement becomes slow and uneven. For short-term participants, this environment feels unproductive. For long-term capital, it is functional. Silence reduces noise and emotion, allowing positioning decisions to be made based on structure rather than sentiment. Capital with long HOR. IZONS does not need reassurance from headlines or daily price movement. It needs alignment with long-term trends and systems that can scale. Excitement changes behavior. It increases urgency and compresses time frames. Investors begin chasing confirmation instead of evaluating fundamentals. Long-term capital avoids this environment because emotional participation distorts pricing. When everyone wants in at the same time, risk rises and opportunity shrinks. Silence, by contrast, creates space. It allows patient capital to enter without competition and without the pressure of public expectation. This pattern repeats across markets. Accumulation happens when assets feel boring, ignored, or doubted. Distribution happens when confidence feels easy and participation feels safe. The difference is psychological, not informational. The information is often available early, but few are willing to act on it without emotional reinforcement. Understanding this behavior helps investors reframe quiet periods. Instead of seeing silence as a warning, it can be recognized as a natural phase in capital formation. Long-term capital is not trying to feel right in the moment. It is trying to be positioned before conditions change. That positioning rarely feels exciting. It feels patient, disciplined, and often uncomfortable. Silence is not the absence of opportunity. It is the environment where long-term opportunity is built. Many investors treat price as the primary signal of value, progress, or failure. When price moves, confidence increases. When price stalls or declines, doubt follows. This response is natural, but it misunderstands how markets actually function. Price is rarely the first thing to move. It is usually the last. Before price reflects change, a series of deeper developments must already be in motion, often quietly and without public attention. Markets are built on structure, not emotion. Infrastructure, liquidity pathways, regulatory alignment, operational readiness, and real-world integration develop long before price responds. These elements do not create excitement because they do not offer instant feedback. They require time, coordination, and testing. While these foundations are being formed, price often appears inactive or directionless. To the short-term observer, this looks like stagnation. To long-term capital, it looks like preparation. Price responds only when enough of these underlying components align. Until then, movement is limited because the system is not ready to absorb scale. This is why early phases feel slow. There is no reason for price to revalue an asset simply because expectations exist. Markets reprice when conditions allow participation at higher levels without breaking the system. That process happens behind the scenes. Another reason price lags is liquidity behavior. Capital does not enter markets emotionally. It enters when risk is understood and pathways are clear. Large pools of capital require regulatory clarity, custody solutions, settlement reliability, and predictable rules. These requirements are not visible on a price chart. They exist in legal frameworks, operational systems, and institutional planning cycles. When those elements are incomplete, price remains contained, regardless of potential. Retail investors often assume that if price has not moved, nothing has changed. This assumption leads to frustration and premature conclusions. In reality, many of the most important shifts occur during periods of apparent inactivity. Systems are adjusted, relationships are formed, testing occurs, feedback loops are refined. None of this creates headlines, none of it provides emotional reward. But it is precisely what allows future expansion. Price movement, when it finally occurs, tends to be compressed. It reflects months or years of prior development in a much shorter time frame. This creates the illusion that something happened suddenly. In truth, the movement is simply the visible result of long-term groundwork becoming effective. Those who focus only on price often mistake the end of the process for the beginning. This is why price-based decision-making is unreliable in early and middle phases. Price is reactive, not predictive. It confirms what has already happened. By the time price sends a clear signal, positioning opportunities are often reduced. This does not mean price is irrelevant. It means price should be interpreted in context, not isolation. Understanding that price is the last thing to move changes how investors interpret quiet periods. Instead of viewing lack of movement as failure, it becomes a reminder that markets operate on timelines longer than emotions. Progress does not announce itself through daily candles. It emerges through alignment of systems. For disciplined investors, this perspective encourages patience without blind conviction. It allows them to monitor structural developments rather than emotional fluctuations. It also reduces the impulse to react to short-term noise, which often leads to misaligned decisions. In long-term markets, visible outcomes lag invisible preparation. Price reflects readiness, not potential. When readiness is incomplete, price remains restrained. When readiness is achieved, price adjusts quickly. Recognizing this sequence helps investors maintain clarity during periods that feel unproductive. It reinforces a simple truth: if price were the first thing to move, opportunity would not exist.